Welcome back to Mastering MHA MBA. This is Chapter 12, Part 2 of 3. In Part 1, we covered why companies budget. Now we build one. We will assemble a master budget in the exact order finance teams use, starting from a single sales forecast and ending with the cash position and balance sheet. Each step feeds the next, so order is everything. Recall the master budget has two halves: the operating budget, which builds up to a projected income statement, and the financial budget, which builds the cash budget and budgeted balance sheet. We build the operating half first because its results feed the financial half. And the whole sequence starts with one number that knocks over every other domino: the sales forecast. Almost everything in the budget is ultimately driven by how much you expect to sell, so getting that first estimate right matters enormously. Step 1 is the revenues budget. You forecast how many units you expect to sell and at what price, which gives expected revenue. This is the foundation of the entire master budget because production levels, material purchases, staffing, and cash all flow from it. If the sales forecast is wildly off, every downstream budget is wrong too. That is why companies pour so much effort into demand forecasting, and why, as we will see, this is one of the first places they are putting artificial intelligence to work. Step 2 is the production budget, which translates the sales forecast into how many units to actually make. The key insight is that production does not equal sales because of inventory. You take the units you plan to sell, add the ending inventory you want on hand, and subtract the inventory you already have. The result is the number of units to produce. A company expecting a busy season might produce more than it sells now, building stock. This single calculation links the sales plan to the factory floor. Once you know how many units to produce, you can budget what it costs to produce them. The direct materials budget figures out how much material to purchase, again adjusting for inventory. The direct labor budget estimates the hours needed and the wage rate. The manufacturing overhead budget covers everything indirect, from factory utilities to supervision. These three production cost budgets then roll together into the cost of goods sold, the big expense line on the income statement we are heading toward. Step 4 completes the operating half. You add the operating expenses budget, the non-manufacturing costs like selling, administration, research, and distribution. Now you have everything. Take budgeted revenue, subtract budgeted cost of goods sold and budgeted operating expenses, and you arrive at budgeted operating income. That is the operating budget done. It tells you whether the year's plan is expected to be profitable. But profit on paper is not the same as cash in the bank, which is where the financial budget comes in. The financial budget answers the question profit cannot. Will we actually have the cash? Its centerpiece is the cash budget, which lays out expected cash receipts and cash payments month by month. This is where a company spots a cash crunch before it happens. Maybe payroll is due in March, but a big customer does not pay until April, so it arranges a line of credit in advance. Profitable companies go bankrupt by running out of cash, not by lacking profit. The financial budget finishes with the budgeted balance sheet, the projected financial position at year end. One more essential step. Because the whole budget rests on assumptions, smart teams stress test it. Sensitivity analysis, or what-if analysis, asks how the plan changes if a key assumption moves. What if sales come in 10% below forecast? What if material costs jump? Financial planning models, built in software, let finance flex these variables and instantly see the effect on profit and cash. A budget with a sensitivity analysis attached is far more useful than a single rigid set of numbers because the future never matches the forecast exactly. The steps you just learned are timeless. What is changing is the toolkit used to perform them. Artificial intelligence and driver-based models are transforming how budgets get built. Two updates. Our first update. The budgeting software market, led by platforms like Anaplan and Workday Adaptive, has added generative and predictive artificial intelligence that can draft forecasts, run scenarios, and surface insights automatically. That market was worth roughly $6 billion in 2024 and is projected to more than double over the coming decade. For the steps we just walked through, this means the sales forecast, the production plan, and the sensitivity analysis can be generated and regenerated in minutes rather than weeks. the accountant's role shifts from building the model by hand to judging whether the machine's answer makes sense. Our second update is driver-based budgeting. Instead of budgeting each cost line directly, you model the underlying drivers that actually move the numbers. Things like number of customers, units per order, or machine hours. The budget is then calculated from those drivers. Change the customer count and the whole plan recalculates. This makes budgets both more accurate and far easier to flex, which is why it pairs naturally with the rolling forecasts and scenario planning from part 1. You are budgeting the engine of the business, not just its outputs. Let us lock in the sequence. Sales forecast drives the production budget, which drives the materials, labor, and overhead budgets. Those build cost of goods sold, and with operating expenses, you get budgeted operating income. Then the financial budget, anchored by the cash budget, checks whether the plan is survivable in cash terms. And sensitivity analysis stress tests the assumptions underneath it all. That is a master budget end to end. We have built the machine. But a budget is more than a spreadsheet. The moment those numbers become targets that people are judged against, they start changing behavior, sometimes in ways the company never intended. Part 3 is about that human side: responsibility accounting, budgetary slack, stretch targets, and how to budget in a way that motivates rather than distorts. See you there.